Okay, we're continuing with chapter 19 for intermediate accounting 2. On page 1110, we're going to, right on the bottom, we're going to start talking about diluted earnings per share. So we already did basic earnings per share. And now we're going to look at diluted earnings per share. So effectively, diluted earnings per share takes into account other elements that stand the potential of becoming common stock. So things like stock options or convertible stock would be included in this list of what we're going to take into account for our new calculation. So on page 1111, it says securities like convertible bonds not being common stock may become common stock or exercise their conversion. Therefore, they may dilute, and again, reduce the earnings per share and are called potential common shares. A firm is said to have a complex capital structure if potential common shares are outstanding. Besides convertible bonds, other potential common shares that are convertible are preferred stock options and contingently issuable securities. A firm with complex capital structure reports two different EPS calculations: basic EPS, which we talked about last video, which ignores the dilutive effect of these securities, and diluted EPS, which incorporates those dilutive effects. So basically what we're talking about here is if there's anything outstanding that has the potential to dilute my EPS, then if I'm calculating my diluted earnings per share, then I use those in the calculation. So what you'll notice here, and you might want to go back and review the last video if it was a struggle for you, is we're continuing with that same problem. We still have the same net income, same dividends, same additional shares issued, everything we did in the last video. But now we're adding in elements with diluted properties into the calculation so that we can do diluted EPS and not just basic EPS. So looking at illustration 1910 on page 1112, you see that everything has stayed the same from the last video with our common stock of 60 million. We added new 12 million shares that we sold. We had a stock dividend. So all those calculations are going into this with 8 million shares required for treasury stock. The only thing that's changed is that now we have an incentive stock option where in 2017 they have an exercisable stock option in 2017 for 15 million common shares of stock at an exercise price of $20. So 15 million shares and the exercise price is $20. So the basic earnings per share, actually I believe this is a typo in the book because the basic earnings per share should have been the same as the prior one, and it's not. So that's why I haven't marked out in my book. The calculation's wrong there. It should be 150 divided by 75, and $2 is correct. I just mistyped this as 78, at least in my book it does. I don't know if your ebook is fixed or not. But it says the basic earnings per share is unchanged from the prior example. Diluted earnings per share, you see everything stays the same, with the exception of the fact that I would basically take the difference between the shares that are options times the exercise price divided by the average market price. So in this case, I'll just type it out here in case the math is not making sense to you. I have the shares that are issued for an option. So the share option, which is 15, I'll do it in millions, which is 15 million. And we have a $20 exercise price for a total of $300 million is the value of those of the share options. The average market price is 25, which oddly enough, it doesn't say that in the actual problem, but they would have to give you that number. So 25 is the average market price. We take the 300 million divided by the 25 to get 12 million shares. So this is the number of shares that we're going to have to reacquire as treasury stock to resell for these stock options. So the company would effectively what this looks like is the company pays $25 to however how many shareholders own 12 million shares of stock, and then they sell the stock, and they sell a total of 15 million shares for a price of $20 to those that have the option that are exercising the option. Okay. So now I want to do a problem just on that. That's simple. Okay, how many shares are in the option? What's the exercise price? And finding out how many shares of stock, how many shares of stock they actually are going to have to buy back for the treasury stock to get the value to be correct. So 1914 on page 1137. 1914, page 1137 says fully vested incentive stock options exercisable at $50 per share to obtain 24,000 shares of common stock were outstanding during a period when the average market price of the stock was $60 and the ending market price was $60. How many shares will the assumed exercise of the options increase the weighted average number of shares outstanding when calculating the diluted earnings per share? So we're trying to figure out effectively how this affects the denominator in this case. So we need to take the number of common shares, just like we did in the last one. This is a common share really for the stock option. That's 24,000. And we need to multiply that by the exercise price, which is 50. For 1.2 million. And then I'm going to take that divided by the average market price, which the average market price was 60. So 20,000 shares. Okay. So what this does really, and that's not really the answer to this question. The question is that there are 24,000 shares that are going to be exercisable under the stock option, but we're looking to effectively revalue that to say, okay, how does this, because the fact that it's an option, it's being purchased for less money, how many shares of stock does this represent in the market, and how much does it dilute this? What's the difference between the actual number of shares that are being issued for this option versus the value on the market of these shares? Because that's the only way I can adjust to do basically a weighted average to figure out what my actual diluted EPS is. So in this case, it's diluted by 4,000 shares. The 24,000 minus the 20,000. I didn't go into that over here, but realized the amount of diluted, and meaning this is the amount I'm going to add to the bottom of my equation, would be the difference between the share option and the number of shares. Okay, now we're over on to page 1113, talking about convertible securities. So sometimes corporations give bond offerings, notes payable, or issue preferred stock. Convertible securities can be converted into exchange for shares of stock at the option of the shareholder or the holder of the security. For that reason, convertible securities are potentially diluted. EPS or dilutive, excuse me. EPS will be affected if and when such securities are converted and new shares of common stock are issued. So just now we learned that the potentially dilutive effect of stock options is reflected in diluted EPS calculations, assuming the options were exercised. Similarly, the potentially diluted effect of convertible securities is reflected. So we're doing the same thing. We're just talking about a little bit different. We're talking about convertible securities now rather than stock options. So continuing, this is the same illustration. Starts on bottom of 11,113. We have all of our elements have gone into the whole time, the number of shares outstanding, the net income, shares being sold, so on and so forth, and then the exercise option. Now, where this gets different is it says that they issued $300 million base amount, 10% convertible bonds, and they're convertible into 12 million shares. Now, one of the reasons why one of the major differences between bonds and equity, so the difference between selling stock in my company versus selling bonds, to to basically receive capital or receive cash, is that there's tax savings through bonds because interest expense is deductible, but dividends are not. So that's kind of what we're putting into our calculation here. So as you can see, when you look at the calculation, nothing has changed except for we have put the potential after-tax interest savings on the top, and we have also added the conversion of the bonds, the stocks themselves, the number of shares that it can be converted to on the bottom. So we have our net income minus our preferred dividends plus 30 minus 40% times 30. Then 40% times 30 is the tax rate, and the $30 million is the amount of interest, 10% of $300 million. So $30 million worth of interest. So paying $30 million worth of interest saves us effectively $12 million in taxes. And then we divide that by all the numbers we had before, plus the additional 12 million. So we're assuming that we did this. Okay, we're assuming that it happened. Okay, now what happens with convertible preferred stock? Again, another potentially dilutive, financial element. So just like all the other ones, we basically assume that they are going to be exercised. We assume convertible securities were converted as options are exercised at the beginning of the reporting period, not at the end. But the other thing this does is, remember in our calculation that we always subtract preferred dividends from our net income. That would be true in the basic EPS. And diluted EPS, since we work always off the assumption that they are going to be converted, we would take those out because if they're converted to common stock, we no longer owe preferred dividends. So effectively, all I do is take out the preferred stock on the top. I'm looking at illustration 1912 and add the conversion of number of shares. In this case, they preferred stock convertible into 3 million common shares. So I simply add the 3 million common shares that could be converted for the diluted EPS. So let's look at one of these. So basic exercise 1915 on page 1137 says, and this is where you can pause it, try this on your own first. It says, Onberg Corporation had 800,000 common stock issued and outstanding as of January 1. No common shares were issued during the year, but on January 1st, Onberg issued 100,000 shares of convertible preferred stock. The preferred shares are convertible into 200,000 shares of common stock. During the year, Onberg paid $60,000 on preferred stock, dividends on preferred stock. Net income was 1.5 million. What are the basic and diluted earnings per share? So first, we're going back and kind of reviewing the basic EPS, which the basic EPS, remember, is net income minus preferred dividends divided by all that, divided by shares outstanding. Remember, that can be a hard number to get if we have things like stock dividends or issued stock throughout the year. Luckily, this one doesn't have either of those, so it's pretty straightforward. So I can just take my net income, use parentheses so it does math right here, net income minus my preferred dividends, I probably should label those preferred with the cash dividends, divided by, with no new shares issued, 800,000 to get my basic EPS. EPS of $1.80. And my diluted EPS. So my diluted EPS, I need to make sure and make the assumption that anything that could be dilutive, anything that could dilute this, is being done. So in this case, the only thing that we've got listed out that could be dilutive in this case is the preferred shares converted to common shares. So if that were to happen, I would have my net income, 1.5 million. I do not need to take my preferred dividends out, because if we're working off the assumption the preferred are converted, then there would be no preferred dividends. So just the net income divided by the 800,000 shares initially issued. And then again, if we're assuming that they're converting, we need to add the additional shares. And since we're assuming conversion, we do always assume, I said this a few minutes ago, but we always assume it's converted at the beginning of the year. Oops, this is why I always use parentheses, even when I don't necessarily need to. So $1.50 would be the diluted EPS. Oops, I already labeled it, sorry. And that's where we'll stop for this video.